Look, we're powering through the asset classes, guys, and in the process we've gained some key insights for our clients, and now it's over the asset class that everyone is an armchair expert in, international equities. Are they still a key driver of returns? Are they expensive? Are they cheap? Should we hedge? Should we not? Will Trump be the next president? Will the Brisbane Lions and the Brisbane Broncos both win premierships? Some of these things are going to be covered by the panel today. Dominic McCormick, Monik, Kotecha, Rob Makdissi and Ashley Owen. Dominic's been providing investment consulting for 35 years. I'm finally found someone who's been hanging around longer than me, so thanks, Dominic. He co-founded Select Asset Management in 2002, which he subsequently sold, and continues his long-standing career focused on portfolio construction and real returns. Monik is CIO at Insync Funds Management and has worked, again, over 30 years across international and Australian markets in London, New York and Sydney. He was previously with IML, and most importantly, he is yet another success story of BT. Rob is investment manager at Akambo, an Australian-based funds management success story that you might not have heard of yet, but watch this space. He came to Akambo from UBS, Morgan Stanley and Balliol Holst, where he has managed portfolios and trading across Aussie and international equities and also derivatives products. And Ashley Owen is, of course, from Owen Analytics. His background is at Stanford Brown, Centric Wealth, ANZ and Philo Capital Advisors. His academic credentials are extensive and range from law to economics and, of course, a CFA charter holder. So there's over 100 years experience up here, guys. Enjoy.
Although in the foyer this morning I was mistaken for Tim Hext, who chaired an earlier session. I'm not sure whether that's a good thing for him or me. But unlike him as a Gen X, I do just scrape into that that ugly baby boomer category. And I probably won't be as funny as Tim. But we've already had some coverage of the key issues impacting global equity markets, you know, AI, valuations, interest rates, the concentration we're seeing in some markets. But the aim of this session is to dig into some of these. But we're going to start with Monik giving a few slides and a few views, and then we'll develop the discussion from there.
Perfect. Okay. So, hard landing, soft landing, no landing. Really interesting points to debate, and I'm sure we'll go through a lot of them shortly. Together, you know, the macroeconomic tea leaves are always very, very hard to forecast in the short term. I think it's fair to say that when everyone was looking at back in December what the economy, inflation rates, equity markets will do 6 months later, it's fair to say that consensus was largely wrong. But there are important points to debate because one has to be thoughtful when we're putting a portfolio together. So look forward to doing that shortly with the panel here. I think this chart's quite interesting because while all of those factors are really important, I'm obviously global equity specialist. I think the most important thing this chart demonstrates is that ultimately it's earnings that drives equity returns up. And it has always been the case. So the green line there, it actually shows you what valuations have been over time, and they've sort of been moving around from time to time. But the one clear correlation that comes through from this chart is that the blue line, which is the price, tends to follow the red line, which is the earnings. Okay, so the important role I suppose we have is just making sure we're sort of forecasting earnings going forward, particularly from my perspective at a stock level, because that's what I do. So I just wanted to give you a couple of quick examples, because obviously we've been in a very volatile period, and I think there's been particularly the last 18 months, there's obviously been a large focus on top-down factors, as we discussed. Clearly 2022 was a very, very challenging year, and there was a lot of focus on inflation, interest rates, and what that means for equities. So just a couple of examples here. So, if you look at Booking Holdings, so that's obviously the booking app that we all use. Again, when you look at the two lines there, the purple line is basically the earnings. The white line is basically the share price. And, despite all the economic turmoil, The secular forces, what we call the big mega trends, they don't get impacted by the economy. They keep moving forward. So again, it's about finding those companies that have those sustainable earnings growth ahead. And you can see here that the purple line today is higher than where it was pre-COVID. Okay, so there's more people traveling today. Investors are spending more on experiences and travel. And so if you can find those secular growth sectors, you can be less concerned about where the economy is going. Likewise, with Adobe, you can see 2022, we obviously had the multiple compression. Yes, with such a rapid rise in interest rates, it was bound to have an impact in the short term in stocks. But really in the long term, again, it's all about earnings. And that's what I'm just trying to show you here through a simple chart, is to say, well, if you can find companies that can deliver that sustainable earnings growth, then you should be fine, owning companies like that. So just a final chart here, just in terms of what I think are some of the more attractive secular trends out there. These trends tend to be less sensitive to the economy. They're not all technology driven. There's a lot of non-tech trends out there. The aging of the global population, well, that's not impacted by interest rates and inflation. We're just aging as a global economy, particularly in the developed markets. Okay, so if you find businesses that are going to benefit from that, then you're going to be in a good place. And likewise with pet humanization, post-COVID, that's always been a long-term secular trend. And if anything, in a post-COVID world, that's actually accelerated. So again, if you can find businesses that have exposure to these big mega trends, then I think you can be less concerned about where interest rates in the economy are going to go over the short term. So in terms of some of the macroeconomic factors and some of the other points that are worth debating about, I think a big concern back in late last year was what earnings were going to do. Are we going to have a massive earnings recession? And we certainly have had a mild earnings recession, but I think there was a lot of debate as to the extent of the earnings recession. And interestingly, the stock market is a forward-looking. It tends to look forward 12 to 18 months ahead. So back in 2022, so if you look at the bottom chart, that's basically what the market was, or certainly the sell side analysts were thinking earnings will do in 2023. And the top line is what over time analysts were thinking earnings will do in 2024. And if you go back to early 2022, you can see that analysts were already predicting a severe downgrade in earnings. Okay? And that became very quickly reflected in the share prices in 2022. So we had already had a fall in equity markets that reflected that view very, very early on. What I find quite interesting today is as we continue to debate about these factors, you can see that consensus earnings are actually starting to increase both in 2023 and 2024. And then if you look at valuations, valuations are certainly very important, particularly if you start off with very high valuations. Clearly, history would tell us that returns tend to be lower going forward, and I would generally tend to agree with that. And if you just strip out the bubble periods here today, back in 2020 and back in 2000, you can see that valuations generally are trading at the top end of the range today. Okay. Now, does this mean that markets won't perform going forward? Well, you don't need valuations to change if earnings keeps on growing, because the share price will reflect the growth in earnings that comes through to the market. So, but that's an interesting chart. You notice certain things. One is that emerging markets have always been cheap. And certainly the discount today is very, very great. And I think one area which would probably be quite interesting to talk about is valuations and where the value opportunities are and whether they're really going to work going forward. Because really for the last 5 years, for example, the US has been the most expensive market. If you listen to most commentators, they'll tell you to be underweight the US. And the best performing market through most of that period actually has been the US. It's good to understand why that has actually occurred. So in terms of points of debate, I think these are the key points. Is inflation sticky? Is it, we know it's been coming down, but is it going to come down significantly more from here? We know interest rates have gone up significantly. I think one of the big surprises has been how resilient the global economy has been in the face of really the most rapid rise in interest rates we've seen almost ever. And then obviously the other important question is, is China What does that mean for exposures to emerging markets? What does that mean for the global economy? I thought this was an interesting chart to share with you because obviously there's been a lot of debate and there continues to be a lot of debate about recession and recession risk and hard landing. And these are is a chart of showing how often corporates in the US have actually been making any mention of a risk of recession risk. And you can see that the number of companies that are actually talking about recession risk is actually significantly declined in the most recent period. So just to finish off with, I mean, coming back, I think, to where is an attractive area to invest, we can certainly go into that in a lot more detail. You've got all these different styles, you've got value, you've got growth, you've got quality. And I think the one thing I would say is that, if you can find businesses with sustainable earnings growth, then there's a higher probability that you'll probably do better with that strategy with less risk on the downside. So I'll now move on to the panel. Thank you for that.
Okay, well, we might sort of start with that sort of valuation issue, in terms of, what do, current longer-term valuations sort of look like and mean for investors sort of going forward? And also sort of, are we doing a good job sort of communicating those likely returns? I might start with Ashley.
Thanks, Tom. Welcome this morning. I'm not sure what sort of hasn't been covered. There's 4,000 questions. The sort of opening comment, having been to a few of these and met a lot of you before, is everyone's got sitting down here watching and getting a coffee and hopefully none of you yawning after all those bond comments about loving bonds, which I'm still ringing in my ears. But you've got to ask yourself, this is interesting stuff, you get points and coffee, but what are you going to take out? What are you going to do differently next Monday or next committee meeting? And a lot of you will look at it from stock pickers, either advice firms or principals in advice firms or investment committees in advice firms or asset consultants to advice firms. So the question is, and I sit on a lot of committees from family offices down to retail advice firms, and they're all trying to do different things. Some of them trying to pick timing, are we going to go to a recession or not? Some of them trying to pick styles, some of them, is value dead? So it's very hard to cover all of those topics without focus on what you particularly want to do with your firm next meeting or next client that walks in. So I'd probably start by saying that the biggest waster of time in investment committees I've ever come across by a factor of 100 to 1 is endless debate over, are we going to have a recession? It takes up 90% of every committee's time, and it means absolutely nothing. You sit there at the back and say, are you done yet? Can we get on with it? It makes no difference at all whether we're going to a recession or not, for a whole lot of reasons. So the question is valuations, which is a very important question. Now, I'm probably the oldest one born in the 50s. Anybody else born in the 50s? One, David, thank you, and 2, 3. So the beauty of that is twofold. One is you get to see Collingwood lose massively several times in your life, which is great. Sometimes by 100 points, sometimes by 1 point, trudging home in the mud at Victoria Park. They're all good. The other thing is you get to see a lot of cycles. My first job was in the early 80s after the big late 70s building boom and finance boom, and then they had the mining boom and then the big crash in the 80s. I got a job in the 80s, so literally 40 plus years ago now. You can see a lot of cycles. Every textbook in the world, finance textbook, has been written in the last 30 years, which has been this great disinflation period. Interest rates have gone from 15% to 0, or even now 3-4%. Big deal, get over it. You've had this massive bull bond run, which has given bonds, equity-like returns for pretty much no risk. So everybody says, we get the inflation protection of bonds. And a lot of that's nonsense if you look back further in time and you realise what really goes on. So equities, global equities, which is effectively US equities, 65% of the index, has returned pretty much double-digit, 10, 11% returns, total returns before inflation. We'll get to that in a second. Pretty consistently, we've had 87 crash, we've had the early 90s, early 80s, we've had COVID, but they come and go. But ultimately you get 10-ish%, double-digit returns. Australia's the same thing over a 20 or 30-year period. Now, in real terms, because inflation was low for most of that period, Equities have returned 6, 7, 8% total returns for a generation. Not forever. If you look back the previous 30 years, you get to periods where the real returns from equities was zero for decade-long periods. So when talking about valuations, yes, you've got the global PE ratio right now is about 21, in the US it's 25, forward PEs are around about 17 in the globally, about 20 in the US. So all of those are elevated, and all of those are based on the experience of the last 20 or 30 years. We say, well, PE ratio should be around 20, maybe 18, maybe 22. For a low inflation world, that makes sense, and it's delivered double-digit returns for a generation. So the key question is, are we heading back to the previous 30 years where we had persistently high inflation due to a whole bunch of factors? The oil crisis was two furphies in the middle. It was really just the spending out of the post-war spending, the Vietnam spending, the baby boom. A lot of things drove that higher inflation environment from the Second World War to the 1979. So if we are facing that period again, we're going to go to nominal returns from global shares on Aussie shares, not 10% plus for decades. They're going to be single-digit returns, nominal. Take off inflation, perhaps 3, 4%, perhaps 3%, maybe even 2%. No, 4% less 2 gives you real returns of 2-ish%. That's total, that's including dividends, or add 1% for franking. They are very different returns than the people, your clients, were used to as they built their wealth after the last 20, 30 years. So explaining that to them in words that they understand, which means basically lower living standards that they expected, higher than anyone expected 20, 30 years ago. They're now sitting on a pot of $2, $3 million they never knew they would have. Now they've got it. They're saying, well, okay, I'll get double-digit returns. I'm going to get that forever. No, you're not.
Actually,
so that's probably the biggest implication of how to explain to your clients how that last 30 years ain't going to happen again ever.
yeah, we might give the others a chance to sort of possibly refute that.
Oh, thank you. Look, a lot of the points you make I think are really valid, but it's all about the starting point and where are you buying value. So is there value at the moment? There is in certain regions of the world, certain sectors. But to your point, we do think that it's going to be a lot more challenging and volatile period that we are entering. So valuations, you look at the US, and as Monik pointed out, the US has since 2008 been exceptional versus the rest of the world on an earnings basis, but also on a performance basis. Why has that occurred? There's probably a myriad of reasons, but post GFC policy impacts from central banks were quite pronounced. Is the world turning? To Ashley's point, perhaps, and we think that over a long period, most likely, but we will get a lot of volatility in between. So, I guess the point to take is always remember what value you are buying something at. What is your growth expectation? And don't assume that the growth expectation in markets that is assumed today is going to continue forever. And there's a lot of examples in markets today where there's a lot of, a lot of fervour with regards to future growth. And it's something to keep in the back of your mind if you look at through history, that doesn't often manifest itself in the way that the market currently expects. So I think they're probably the major points. There is value in the market. There will be challenges. Expect volatility to increase in our view. We are probably entering a new regime, but that regime probably means it will be a lot more volatile.
Yeah, just before Monik's point, one of the disconnects that I see from commentators and sort of fund managers, is at the index level, where we're talking, clearly valuations are at high levels, but they often point to the value that Monik's already mentioned, emerging markets, some smaller caps, some specific sectors, whether it's energy. But the disconnect I see is that when you look at portfolios, they're still very heavily weighted to, large cap, growth, tech stocks. And you can understand the anchor that the index is pushing people like that. But should people sort of look a bit more differently, given the full opportunity set that's out there?
I'll run with that first. I think so. If somebody said close your eyes, buy something today, I'd buy it on valuation alone, and I think there is value outside of the US, in particular certain sectors. That said, to Monik's point, I think it's very valid. If something has sustainable earnings, it will keep up. But the reality is a lot of these companies, a lot of these sectors won't have the sustainability of earnings that the market is currently pricing in. And I think that's the major consideration to make. What's going to be the catalyst for the market to switch from perhaps liking one style over another? Perhaps it's acceptance of higher rates over a long period. That might be the case. It might be something else. It might be China re-emerging. It might be Asia re-emerging as a growth leader. I don't know today, but there's a number. I can give you 20 different catalysts. But until there is a catalyst, the current regime will keep going on until something breaks. It's similar to what we had a couple of years ago when interest rates rose a lot faster than people anticipated. It changed the consensus. So today's consensus is very much about tech disruptors growth coming through. And that's what's going to change that. Well, it could be a economic regime. It could be simply that the earnings don't keep up, or it just could be competition or regulation.
Yeah, I think what's sometimes not well understood in markets is that when you got to look at the structural macroeconomic settings when you're looking at stocks and businesses and what's actually going to work. There's a reason why I think for most of the period since 2008 that a lot of, let's call it the value sectors, and they do have their moment in the sun. 2016 was one, 2022 was another one when we had that abrupt lift in interest rates. And really, we had a move into those value sectors thinking they'll perform very well, which they did in 2022. Interestingly, in 2023, they're now reverting back to the way they performed pre-COVID. They're starting to underperform again. And understanding those secular factors, I think, are really, really important, because if you think about the environment we're in pre-COVID, it was one where we had rising debt levels, rapidly rising debt levels, and demographic issues. They haven't gone away. One of the reasons I believe China is struggling is because it's under severe debt problems at the moment. You know, for every dollar of GDP, you need to spend $4 now. That's what they have to do. And the Pew Research Institute recently just came up with a forecast. It was a range of forecasts saying that by the end of the century, there'll only be 700 million people in China as opposed to 1.4 billion people today. So there's similar issues in other parts of the world, and they're basically disinflationary factors at the end of the day. So for certain capital-intensive sectors to work well, or value sectors to work well, you need low interest rates, you need rapidly rising real economic growth for those things to do very well. And that's not the environment we're in at the moment. So it's very easy to keep on going back to valuation, and it does work from time to time. There are moments when they will have another great year, but you really need to understand the structural and secular forces at play when you're looking at picking sectors and stocks.
I mean, just one other macro issue. I mean, in the US in particular, you know, you're seeing this conflict between, you know, very tight monetary policy, albeit we might be, you know, getting to the peak, and very loose fiscal policy, which has perhaps sort of, you know, staved off this risk of recession. I mean, how are you looking at that sort of challenge for markets and how that plays out in terms of the risks for markets going forward? Perhaps Ashley first.
It's a good question. I mean, we're all sort of bottom-up stock analysts. We look at stocks, Apple and Microsoft and Tesla from the bottom up. What are their earnings? What are their profits? But at the end of the day, you've got to look at the macro as well. So, for example, the total global profits in 2019 was 2.9 trillion. 2020 it was 1.7, so $1 trillion got taken out. Last year, 2022 calendar, it was 3.9 trillion. So somehow, forget COVID, there's $1 trillion more profits, that's profits after tax reported by companies last year than there were in the previous pre-COVID boom. Now, where's $1 trillion come from? And that's despite rates going from 0 to 4%. There's still $1 trillion more profits than there was in the system than there were pre-COVID. That's come from basically stimulus. As a couple of sessions ago pointed out quite correctly, you've got quite certainly tighter monetary policy in the world now, rates going from 0 to 4, 5, 6%. But the physical policy, which is just the cash put into people's pockets for free, mostly in the US now, that's still, the taps are still on, and that's going straight to bottom line profits. So at a macro level, the 2023 forecast profits globally, consensus earnings is around about 4.4 trillion. There's another $500 billion that's going to be booked in profits by companies reporting around the world than was last year. Seems outlandish that we're in a slowdown and spending slowing, but that's happening. And look at the one by one, the reporting in the US in July and in Australia to a lesser extent, but certainly around Europe and particularly Japan, profits are through the roof. It's coming largely from stimulus, which largely now is fiscal stimulus, ultimately out of Europe, a bit of China, but mainly US. Is that going to stop? I don't think so. That's going to be stimulatory for a whole lot of reasons, let alone the inflation reduction and the onshoring, capex spent on renewable energy, social programs, social housing, all through Europe and particularly the US. I don't think that's going to stop. So that's going to be stimulatory for a long time to come. Yes, the US dollar's got its future mapped out, or the US dollar's lasted 60 years, and it won't be replaced tomorrow. It'll probably be around as strong as it is today in 10 years' time. So the US is under no physical, some political, but no physical constraints fiscally. So I think that spending is going to be strong for a long, long time, all of which is good for profits, which underpins share prices.
Any other comments?
Yeah, I think that's a really important point. Fiscal policy is driving, in our view, the profit growth and the earnings growth. So despite the fact that we have tighter monetary policy, you could also argue that there's also been underneath the surface further stimulus from central banks. If you look at markets, when they bottomed last year, October, we had the gilt crisis in the UK. The second time markets bottomed this year was during the SVB banking crisis. Both times we had the BTFP in March. We had a lot of stimulus come through from central banks, not called QE, but you can call it whatever you like. But there was a lot of stimulus coming through and liquidity coming to the system. So I think that one of the big questions, and this is that conundrum of where do rates go, is can politicians continue to spend? They'd like to. What stops them is the bond market and or currency markets, one of the two. At the moment, it's all okay, and the US has got a very privileged position with its US dollar and its ability to raise funds. What is interesting is they got deficit to GDP of debt to GDP of 8%, and this is a time when the employment is at 3.5%. What happens if they do go into a recession? They have to really stimulate. What happens then? How does the bond market react? So these things can take a long time to develop. I'm not here to time it. I don't know how long it will take before that, but there is going to be some limit as to the fiscal spending that politicians can keep pushing through. And I think it's a really good point that Owen made with regards to where's that profit coming from, and it's really a transfer from government's debt into private sectors, whether that be in people's pockets or corporates' pockets.
Okay, we might just open to the room for questions.
Just on the topic of which sectors and regions you're seeing that are attractively valued. Obviously, there's been a strong run-up in Japanese equities this year. There's obviously been investors that are reassessing their underweights to Japanese shares, and there's been some obviously corporate policy changes there as well. Do you think that rally has essentially topped out, or do you think that there's some further room for a run-up in that?
Yeah, good question. Interestingly, Japan is still below the highs it reached in 1989, which I think is quite an interesting observation. Obviously, there's some positive changes going on in Japan in terms of capital allocation and trying to improve return on capital, which we believe is the big driver of equity prices in the long term. And that is positive because, if you get positive changes in return on capital, that typically leads to better share price performance. So I think it's probably a good place to be still over time. I mean, we struggle because the return on capital generally in Japan is far too low based on what we do. But if someone was asking me, is it a good place to be still with the positive actions taking place there, I would say yes, it is.
Don't forget the Japanese market's done well this year because the yen's crashed. It's the only country left doing QE. That's now starting to be eased off. But if you hedge the yen, which you can, and get a carry, good. That's not a long-term trade. So look at the underlying earnings in the currency and the reasons for the yen doing well. The reasons for the Japanese companies doing well. It's the yen, and that's not sustainable trade.
Can I ask a question about China? There was a lot of talk about China as a sort of threat to the outlook for markets and economies and so on. But I mean, China is a leader in EVs, solar panels, all sorts of things that we're moving towards. Do you see China as an opportunity for investment?
I think when you look at the construct of the Chinese market, it's a bit like the European market. You know, why is there good value there? It's simply because it's got a lot of those older style economies. A bit like Europe. If you look at European earnings, for example, I'm answering your question in China, but you know, something like 25% still comes from bank earnings, 30% comes from energy, materials, in utilities. You've got 55% of earnings in Europe coming from those types of industries. So if you have a really strong secular positive view on that, then by all means go overweight Europe. But I think China is sort of quite similar. And obviously with China, you've obviously got the authoritarian sort of and regulatory issues that are really come to the fore in the last 2 to 3 years. So look, as I said a bit earlier, I think there's some real challenges. I think there's a reason why it's cheap. You're right, they are leaders in those spaces, and that will create more competitive pressures for companies that are competing in that space in the developed markets. And you know, if you're an export economy like Germany to China, then you've got a potential problem as well. And again, that's one of the benefits of the US. I know it's done really well and it's expensive, and you do have to be a bit cautious and really quite thoughtful. But the US as an economy is less reliant on China than a lot of the European economies are.
Okay, guys, I think we'll have to call it there if that's okay. Thanks, Dominic and panel. Well done.